Most freelancers think they are stuck paying whatever the IRS tells them to pay. But here is something that can change how you think about your taxes forever. As a freelancer, you have more control over which tax bracket you fall into than almost any W-2 employee. And once you understand how to use that control, you can legally keep thousands more dollars every year. Today, we are going to break down exactly how freelancers can strategically choose their effective tax rate in 2026, with a real example showing how a $95,000 freelancer drops a significant portion of their income into a lower bracket. Welcome to the Freelancer's Wealth Blueprint. Subscribe for tax and wealth building strategies built for the self-employed. First, we need to clear up the most common tax misconception in America. Most people believe that if they earn enough to land in the 22% tax bracket, all of their income gets taxed at 22%. That is wrong. Tax brackets are marginal. In 2026, for a single filer, only the first $11,925 of taxable income is taxed at 10%. Income from $11,926 to $48,475 is taxed at 12%. Income from $48,476 to $103,350 is taxed at 22%, and keeps going up from there. Each bracket only applies to the income that falls within it. So even if your taxable income puts you in the 22% bracket, a large portion of your income is still being taxed at 10 and 12%. This is why your effective tax rate is always lower than your marginal rate. Now here is the key insight for freelancers. If you can reduce your taxable income enough to push some of it out of the 22% bracket and back into the 12% bracket, you save 10 cents on every dollar you move. That adds up fast. And freelancers have more tools to do this than almost anyone else. Let me walk you through a concrete example. Say you are a single freelancer with $95,000 in net self-employment income in 2026. Let us trace the path from gross income to taxable income and see where the bracket management happens. Step 1. The self-employment tax deduction. You pay 15.3% SE tax on 92.35% of your net income. Half of that SE tax is deductible above the line. On $95,000, your SE tax is approximately $13,413, and half of that, $6,707, comes off the top. Your adjusted income is now $88,293. Step 2. Solo 401k contribution. You contribute the maximum employee contribution of $23,500. This is an above-the-line deduction that reduces your AGI directly. Your adjusted income drops to $64,793. But you can also make an employer contribution of up to 25% of your net self-earnings after the SE tax deduction. That is roughly an additional $22,073. If you max out both, your AGI drops to approximately $42,720. For this example, let us say you contribute just the employee portion of $23,500, bringing your AGI to $64,793. Step 3. The QBI deduction. The Qualified Business Income deduction gives you 20% of your qualified business income. On your freelance income, this calculates to approximately $17,669. This deduction does not reduce your AGI, but it does reduce your taxable income. Step 4. The standard deduction. In 2026, the standard deduction for a single filer is $16,100. Now let us add it all up. You started at $95,000. After the SE tax deduction of $6,707, the solo 401k employee contribution of $23,500, the standard deduction of $16,100, and the QBI deduction of approximately $17,659, your taxable income is approximately $31,034. Look at what just happened. You started in the 22% bracket. Your taxable income of $31,034 is now entirely within the 12% bracket, which tops out at $48,175 for single filers in 2026. The income tax on $31,034 is roughly $3,504. Add the $13,413 in SE tax, and your total federal tax bill is approximately $16,917. That is an effective federal tax rate of about 17.8% on $95,000 of income. Without the solo 401k contribution, your taxable income would have been about $54,134, putting roughly $6,000 into the 22% bracket instead of the 12% bracket. That single decision saved you about $600 in income tax, plus you now have $23,500 growing tax-deferred for retirement. Now let me show you additional strategies to manage your bracket. Income timing. As a cash-basis freelancer, you control when you invoice and when you receive payment. If you are approaching a bracket threshold in December, you can delay sending invoices until January, pushing that income into the next tax year. On the flip side, if you had a lower income year, you might accelerate invoicing to pull income into the current year where it will be taxed at a lower rate. W-2 employees cannot do this. You can. S-Corp salary optimization. If your income is high enough to justify an S-Corp election, you can split your income between a reasonable salary and distributions. Only the salary portion is subject to SE tax. The distributions are subject to income tax, but not the 15.3% SE tax. For a $95,000 freelancer, this may not make sense after accounting for the additional payroll costs. But at $120,000 or above, the savings often justify it. This does not change your bracket directly, but it reduces your overall tax burden significantly. Bunching deductions. If you normally take the standard deduction but have years with higher deductible expenses, consider bunching. This means concentrating charitable donations, state tax payments, and other itemizable expenses into a single year so you exceed the $1,600 standard deduction threshold. In the off years, you take the standard deduction. Over 2 years, you deduct more total than taking the standard deduction both years. Married filing jointly. If you are married, filing jointly dramatically changes your bracket math. The 12% bracket for MFJ extends to $96,950 instead of $48,475. Combined with a standard deduction of $32,200 and 2 QBI deductions if both spouses have business income, a couple can shelter significantly more income from higher brackets. If your spouse has W-2 income, the combination of W-2 and freelance income also opens up additional planning opportunities. The big picture. You are not stuck with your tax rate. Every dollar you contribute to a solo 401k is a dollar that moves out of your highest bracket. Every dollar of QBI deduction drops your taxable income. Every invoice you strategically time shifts income between tax years. These are not loopholes. These are the tools the tax code provides, and freelancers are uniquely positioned to use them because you control your income timing, your retirement contributions, and your business structure. Your action steps. Calculate your current taxable income and identify which bracket you are in. Max out your solo 401k employee contribution at $23,500. Claim your QBI deduction. Review whether income timing or bunching could save you more. And if your income exceeds $120,000, evaluate an S-Corp election with a CPA. Subscribe for more freelancer tax strategies. See you in the next one. This content is for educational purposes only and does not constitute tax advice. Consult a qualified tax professional for guidance specific to your situation.